Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
1924, the year President Jimmy Carter was born. Same year my father was born.
Amazing.
Extraordinary. 100 years. It's just amazing. You think about the life that President Carter had. It's just extraordinary. You want to there's so many different facets to his life: pre-presidency, presidency, and then of course the post-presidency, which just as amazing. My sister did Habitat with Humanity for President Carter and his wife for decades. They went all over the place. Haiti, everywhere. And it's just an extraordinary life. Terry Haines joins us. He's the founder of Pangaea Policy. Terry, it kind of feels like, we think about our current economic and our current political environment, it kind of feels like Jimmy Carter was from another time and place. How do you think about his legacy these days?
Paul, I think a lot about President Carter's presidency and his legacy, both. There are some resonances with today's political situation. A lot of people point that out. But, I fundamentally, I would say that markets need to give President Carter a huge debt of gratitude today for not only appointing Paul Volcker and breaking the back of inflation, but also setting the run-up of U.S. economic strength that persists even today. So there's a big linkage between Carter's presidency and today, and Carter defending Fed independence by shielding Volcker's ability to continue to apply those policies, which is something that President Reagan also did. Beyond that, I think about Carter having a very fractious relationship both with his own party and with the other side. Then that and a lot of geopolitical bad fortune really helped to make him a one-term president.
Of course, to your point, Terry, he was a one-term president, but it was his post-White House work that Paul was just mentioning about that seemed to really define him. Talk to us more about that.
Well, President Carter wanted to live a useful life, not as a president, including as a president, but wanted to live a useful life as a person. And the degree to which he focused on that and kept to it, his sheer stick-to-itiveness on all that really defined him. And, and you've mentioned some of his many, many good works. And, and I don't need to remind the audience of many more that are being written about today, but between Carter and Nixon, and I'm not engaging in whataboutism here, those two individuals really, particularly Carter, I think, really defined what the post-presidential role of American presidents are, and his continued involvement in public service in lots and lots of different ways is a very positive part of his legacy, and one of the main things for which he'll be remembered.
Terry, I know that President Carter kind of continued some of the efforts that was begun during the Nixon administration in terms of normalizing relations with China. How do we think about that process, that time and place, versus kind of where we are today?
Well, in that time and place, it was very much in the United States' interest, following along President Nixon's opening to China, to continue that policy. And, Carter is responsible for one of the, ironically, for one of the main flashpoints today, which is the ambiguity, strategic ambiguity, the United States calls it, over the status of Taiwan and Taiwan policy generally. I don't fault Carter a bit for that. That happened in 1978 or so. It was a very long time ago. But it shows the United States' interest in wanting to bring China into the community of nations, and the United States' interest in wanting to encourage China along the path of economic expansion. And both of those things resonate today, both good and bad.
Also expand a bit more on when it came to Carter reorienting U.S. foreign policy towards that emphasis on human rights.
Yeah, that was very controversial at the time, and remained controversial. Carter was very critical of the realpolitik, as it was called in the Nixon and Ford administrations, and wanted to introduce a more robust emphasis and focus on human rights. That became a hallmark of his presidency, and again had good and bad resonances. I mean, he certainly helped human rights and helped focus the United States on the human rights dimension of foreign policy, and at the same time, a lot of what ended up happening was things spilling over in a variety of ways that caused his presidency in the United States great difficulty, from Iran to Russia's incursion into Afghanistan and beyond. So his legacy there is very good, but the foreign policy results were and remain mixed.
Terry, the National Energy Act kind of got us thinking about conserving energy, renewable energy, recycling. Talk to us about his legacy there.
Two things. One is that Carter himself. There are a lot of dimensions to this. One is that Carter himself was very convinced very early on remember that his presidency comes in the aftermath of the first gasoline oil shock. That very convinced that the United States had to lead on energy policy and not only adopt an energy policy domestically, but one that was very different from the laissez-faire policies before. He set about doing that. That cost him a lot of political support in his own party, as well as with just kind of Texas oil state Democrats and the like. I mean, it was by no means a unified party on this. So that alone cost him a lot of support. Number one. Politically, but he is responsible for a lot of the architecture of what we deal with today. Secondly, Carter on energy shows the limits of the presidency as much as anything else. Carter thought he could lead by example and frankly dragging both the public along and his own party and Congress along. And he found out that Congress is a co-equal branch of government and was very willing and able to push back at him on this. And there was a lot of dissension in the public as well on what President Carter thought the remedies were, including turning the thermostats way down and alternative energy. So, he showed the limits of the presidency by that, and it's part of the cautionary tale of the Carter view.
All right. Terry, thank you so much for joining us. Really appreciate getting some of your perspective there. Terry Haines, founder of Pangaea Policy.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
20% plus gains in 2023 for equity investors. 25% gains so far year to date in 2024. What do you do in 2025? I'm just going to go in my 2-year treasury at 4.28% and just park it all right there. I mean, why take any more risk? But let's see what the pros are saying. Cam Dawson, she's the CIO of NewEdge Wealth. She joins us here in our studios. Cam, what are you talking to your clients about? I know you've been marketing a lot, talking to your clients over the last several weeks, several months, and going into 2025. What are you telling them about how they should be thinking about 2025?
We're saying that you should not be surprised if forward returns are lower than the last 2 years that we've experienced. And if we were to have another year like 23 and 24, we think that would propel us into bubble territory because of where we're starting with valuations. So we actually think a sideways, somewhat choppy year is the best thing to happen for this market, simply because it would allow us to grow into these higher valuations. And in sideways, choppy years, usually two things happen. The first one is that you have leadership rotations. The second one is that you do get great buying opportunities. So even if it isn't an as exciting of a year from an overall total return perspective, you're likely going to get opportunities to increase equity exposure simply because of that chop.
It seems like the last few years in particular, coming out of COVID, there's so much doom and gloom in 2023, 2024, where people were really underestimating the strength of the economy. And we were just talking about sell-side strategists notoriously getting those calls wrong strong. Next year, they're calling for maybe on average around 9% gain in the S&P 500, but we've continued to see double-digit gains year after year here. So when you're thinking about potentially broadening out, are you thinking maybe the unloved corners, maybe say like a healthcare or real estate, materials? Are we going to see a bid for some of those that haven't been participating in the bull market run over the last 2 years?
I think when we think of the broadening, we have to do it in two kind of distinct time periods, because right now we're going into 2025 with those unloved areas being so very unloved that they are primed for some kind of snapback, but we're not quite sure if it's sustainable, meaning that you could see a 2-week or a 1-month period where value and unloved areas just have a quick snap re-rating. But then the question comes to earnings. And one of the reasons why you have seen these areas underperform so much is because their earnings have been actually rather abysmal. Don't forget, healthcare started this year with an expected 20% growth in its earnings for 2024. The end number will be closer to 3%. So you have to see that deliver.
So if people are underestimating tech again and are doubting that and then potentially miss out on another run, what exactly do you do? Where do you position if you're concerned about particular corners of tech, but maybe there's other areas within that group that you can invest in?
We're not quite sure if they're underestimating tech at this point because estimates have been raised so much. If you think of the growth index, it's expected to go from 4% growth in earnings growth this year to 16% growth next year. But the kicker in that is that the Mag 7, which is about 55% of the growth index, is set to decelerate materially next year because we lose that supernormal growth from the names of like Nvidia and Amazon.
And like the base effects, like the year-over-year effects not being as strong.
Exactly. We have tough comps going into 2025. So if you think about that 4 to 16% acceleration in growth earnings, it means that it's coming from the 45% of the index that's not Mag 7. And that's a pretty high bar. So we're not quite sure if we're going to be able to deliver on that degree of growth earnings, which again feeds into this notion of maybe it's sideways chop if we can't get that full growth that's currently being priced in.
So do I spend more time in my fixed income part of my portfolio here and think about a 2-year treasury at 4.3%, maybe even taking some credit risk? How do you think about fixed income in the portfolio next year?
Well, fixed income from the credit perspective also has extraordinarily high valuations. Credit spreads remain very tight. They're near the lows of the year. That's actually a good message from equity markets, at least in the very short term, meaning that the equity volatility we're seeing is coming more from interest rate volatility, maybe some positioning, not necessarily growth fears. But if growth fears start to bubble back up, that's where credit spreads would have a lot of room to widen. We also think that uncorrelated assets that don't care about the Fed, assets that don't care about equity markets, are a more attractive place to be in 2025 as well. So we look at very esoteric types of assets like litigation finance, but also things like infrastructure. Infrastructure is an area where it's been unloved because it can't compete with 20% plus returns. But if you could give me something that's high single digits that is not correlated to equity markets, maybe that looks more attractive.
Is that a 3M, a Caterpillar, those types of names? Or is it something really infrastructure funds?
Actual infrastructure funds, because if you look at the valuations of those industrial cyclicals, those are also trading at very elevated valuations. Industrials got up to trading 24 times earnings just a couple of weeks ago. So we're not sure that it's there that you necessarily want to be positioned simply because you're pricing in some kind of growth reacceleration that may or may not materialize.
Talk to us about your view of the bond market, because obviously over the summer when we had real yields, people looking toward that direction for a steepening yield curve, and whether that was pricing sort of the risk for a recession. But then obviously we've seen revisions to some of those jobs reports from earlier this year, like in obviously July and September, and then a blowout report in September. And so how do you view that in the direction of the bond market and kind of what that's telling us about the direction of economic growth?
Certainly the last 4 months of the jump in the 10-year yield is a combination of pricing out of recession risk. I think it's also pricing in some kind of risk that the Fed could be too easy when financial conditions conditions are already very loose, as well as the fact that too easy when growth is already robust, meaning that you don't necessarily need deep interest rate cuts to stave off some kind of recession. And so that likely is feeding into where yields are. The one thing we're watching really closely is that we have seen economic surprises turn lower. So just economic data is beating less than expected. You're not seeing it have those kind of revisions upward to the same degree as it was earlier in the year. And so as yields have climbed, economic surprises have turned lower. Those things typically move in the same direction. So there is a notable divergence.
Folks, I'm telling you here, I mean, the week between Christmas and New Year's, a lot of people mail it in. Cam Dawson did not mail it in. She gave us a note today with so much stuff in there. It's going to take me a couple of hours to read here.
Sorry.
NewEdge Wealth, folks. Go to the NewEdge Wealth and check out Cam's research there. Some great stuff. Cam Dawson, thank you so much for joining us. She's the CIO of NewEdge Wealth. We appreciate getting a few minutes of her time and her research note today.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Winnie Cisar, Global Head of Strategy at Creditsights. So, Winnie, again, it seemed like investors were really paid for taking risk in 2024. What do you think about 2025?
Yeah, people were absolutely paid for taking some risk in 2024, which was a view that we had aligned with. But we've been shifting down our risk tolerance, and we actually went underweight credit risk with our 2025 outlook. And this is not necessarily because we think that, spreads are just too tight, but we think that kind of the balance of risk reward here does feel a bit stretched, even though all-in yields are still quite attractive, over 5% for investment grade, over 7% for high yield. We just think that some volatility is probably likely to come in the beginning of the year.
What do you think that tells us about the direction of the economy?
Yeah, so usually credit spreads are pretty good at kind of forecasting the direction of the economy. But I think that at this point, perhaps credit spreads are pricing in a little bit too much of the good and maybe not enough of the potential headwinds. We do think that there is the potential for corporations to benefit from things like deregulation, from the extension of tax cuts. But on the other side, there are a lot of questions around what does trade policy ultimately look like? What is the direction of the Fed's path for monetary policy? Are we actually going to see continued easing in 2025, or do we see inflation start to become more of a challenge again? And that would definitely flow through into corporate earnings. And so we do think that perhaps credit spreads are a little bit too optimistic at this point.
Winnie, what's your base case for 2025 in terms of the U.S. Federal Reserve? It seems like maybe the market's pricing in maybe 2 cuts this year. How do you think about it?
Yeah, so the market has really repriced its expectations for the Fed a number of times. That's been one of the defining characteristics of this Fed, both hiking and easing cycle, that the market is constantly kind of getting ahead of itself in terms of too many rate cuts being priced in. At this point, we have a little bit more hawkish expectation for the Fed. We do expect that the policy rate ends the year around 4.5%, which would indicate no Fed cuts over the course of 2025. Now, this could be because the Fed continues to cut rates, although we do think that the December presser with Powell indicated probably a near-term hold is more likely, especially if the inflation data do not continue to moderate, or if the labor data remain relatively strong, or we could just see kind of this Fed on an indefinite hold, an indefinite pause. We've seen that in prior periods, especially kind of in the mid to late 1990s, and we see a lot of kind of similarities to that period as we have today.
Break down the latest of when it comes to the corporate bond ownership and how non-U.S. investors remain the largest class of owners of U.S. corporate bonds, followed by life insurance companies as well as mutual funds.
Yeah, so when we think about the technicals of the market, this is a really important driver. And I think one of the really important drivers of why credit spreads are so tight right now. You have historically kind of the core institutional base of owners things like life insurance companies, pension funds, those investors who buy bonds to hold them to maturity. They don't trade them around. They want the income that's generated from the coupon. And then you have a few different cohorts of investors that tend to be a little bit less sticky in their investments. This is sometimes some of the non-US investors because they do tend to up and down their allocations to US credit depending on what is going on in the broader global economy, in their domestic economies, and also what's going on within FX. And then we have the retail investors, so ETF and mutual funds, and we've seen a pretty significant increase in holdings of ETF and mutual funds. Usually those are the first ones kind of out the door when you start to see some volatility in the market. So the fact that we have a higher concentration of holding in that less sticky investor base is something that could drive some volatility over the course of 2025 if some of those investors start to get spooked by perhaps negative headlines or a renewed round of recession fears or stagflation fears.
Winnie, talk to us about credit. How's credit quality out there? I haven't heard any really bad stories about credit quality. I'm not sure why that is.
Yeah, so I think that this is one of the kind of bright shining spots for credit right now. Credit quality is generally pretty okay. We had credit really be a tremendous beneficiary from ultra low borrowing costs in 2020 and 2021, combined with earnings that really beat expectations for a number of the periods in the pandemic and even following the pandemic. And that left credit fundamentals in really solid shape overall. Now they have moderated. They've definitely reapproached what we would kind of view as average or kind of long-term normal levels, but we haven't seen a massive spike in defaults that a lot of people were expecting in 2022 and early 2023 when the Fed started hiking rates. And even some of those asset classes that are much more leveraged, like the leveraged loan market, where we've seen a lot of sponsor-backed activity for LBOs and M&A, they've held in relatively well overall. We do think that we're moving into a bit of a transition period. If borrowing costs remain somewhat elevated because the Fed is not able to cut rates as much as people want them to or think that they should, or if Treasury yields just remain elevated because you have other inflationary forces or deficit concerns or a whole host of factors that could keep Treasury yields a bit sticky, then you are going to need to see earnings generation be very strong as well to kind of offset that perpetually elevated borrowing cost. And we do have some concerns that perhaps the type of earnings momentum that people are expecting to see corporate America generate in 2025 is a little bit optimistic right now.
Winnie, I'm sure you're diversified in your portfolios, but you are not diversified in your education. Look at this. She gets her undergraduate degree at Emory University. Okay, great school down in Atlanta. Awesome. And then she stays for another 4 years getting her JD MBA. I mean, that's 8 years at Emory University. I mean, I guess you liked it there, Winnie. Good school and all. JD MBA, really?
Yeah, I mean, it was a great opportunity, and a sad day with the passing of President Carter.
Yep.
But we did benefit from the Carter Center, and he spoke at Emory a number of times, which was always a delight.
Very good. Just such an awesome school down there in Atlanta, Emory University. I mean, they've got the law school, the business school, the medical school.
They've got it all.
Everything. It's just awesome down there in the great city of Atlanta and down in Georgia, I'm sure, mourning the passing of President Carter. Winnie Cisar, Global Head of Strategy at Creditsights. We appreciate getting a few minutes of her time.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Your daily look at the front pages around the world. Lisa Mateo, what do you got in the newspapers today?
Sure. I want to point out what Michael Barr has been talking about, the tributes for former U.S. President Jimmy Carter. They keep coming in. You had President Joe Biden called him an extraordinary leader, statesman, humanitarian. You had President-elect Donald Trump, who said all Americans owe him a debt of gratitude. Then you go to former President Bill Clinton. Remember, he awarded Carter, his late wife, the Presidential Medal of Freedom. They said he worked tirelessly for a better, fairer world. And even President Barack Obama said President Carter taught us all of what it means to live a life of grace, dignity, justice, and service. But they're coming in from worldwide,
Yep.
Not just from around here. And we've been talking about it all morning, not only in the White House, but what he's done outside of that.
Yeah, I saw a tweet from Admiral Stavridis, who was a guest on Bloomberg Surveillance. Oftentimes, he's a voice we really look to for geopolitics. Obviously, a Navy man said, just kind of highlighted the fact that he was the only graduate of the U.S. Naval Academy to be president. So I thought that was pretty cool, too.
Right. And typically you have a market holiday once, I believe potentially it might be on the 9th, if that's the national sort of day. Usually the markets are closed on that, but we'll see what the New York Stock Exchange and others say about that.
If they do, yeah. That is true. That is true. Okay, I want to go to this Wall Street Journal study. It shows how people with higher salaries and net worth tend to live longer lives. But here's the thing, though, that stood out to me. It's not just about how much money you have, but also how you spend it. Okay, so this was in the JAMA Internal Medicine. Once Americans make it to their late 50s, the wealthiest 10%, they live to a median age of around 86 years. Yeah,
wow.
So that's about, listen to this, 14 years longer than the least wealthy 10%.
That seems...
Yeah, so they get into kind of the reasons why. I mean, you think about it, people with more money can afford healthier food, more health care, homes in safer, less polluted neighborhoods. They stress about less things like how to put food on the table. Like, you don't have to worry about that. A lot of lower income jobs are pretty physically demanding. But the interesting part was that it's not just about how much money, but how you spend it. So they suggest certain things, how you can reduce stress if you don't have all the money. Okay, so you do the at-home gym equipment, right? You can't afford the gym.
Lisa
There you go. I'm a
Lisa
huge
Mateo.
proponent of that.
Does it count if you watch somebody do
It
the
does not.
workout?
No,
Okay.
you
Cheer
have to
someone
actually-
else
Yes,
on.
I do that very well.
to partake, but just going out walking, like maybe go out for a walk on the beach. There
Okay,
you
we
go.
did that
See, you
yesterday.
can do that. Good. Limiting the screen time, okay, before bed. That's another thing.
Oh, it's hard.
Okay, how about this one? Drinking less alcohol, eating less restaurant food. Okay, it's not only good for you; it's going to save you some money.
All right.
No, you're not.
All right, here's a
fun.
gerontologist from Cornell University. I often tell people one of the best ways to stay physically and cognitively fit is to go into ballroom dancing.
Oh, have you tried it?
I have not.
Ooh.
I'm not a dancer.
Maybe in the-
no surprise to anyone in this.
New Year's
complete-
resolution,
Yeah, maybe.
2025.
Exactly.
It's a good workout, I'm telling you. Also, those gadgets, they say like the Apple Watch, the what is it, the ring, the Oura ring, all those things.
No.
They say they're good.
Paul's not into it.
please.
It keeps you on track. I don't know, it makes you a little paranoid about your health too, but at the same time, it does keep you on track.
Are we legs or arms today?
Today is actually my day off. I hurt the leg skiing, so
nice.
I'm taking a little bit of a breather.
That's right. You went skiing this weekend.
I
So
did, and you were mentioning the
Tweak the knee.
weather.
Yep.
The rain, not good for the
No, it's not
toe.
good. No.
It was back
No.
by where we were, like all in Camelback and Jack Frost and all that area.
Yep.
Ooh, hit
Yep.
hard by that rain.
Yep, not good.
There. Okay, so this one I thought was interesting also in the journal. Fewer higher level jobs, right? So you have corporate America thinning out the management ranks. So this is Live Data Technologies. They say U.S. public companies have cut their middle manager headcounts by about 6% since the peak of the pandemic hiring spree. A lot of the biggest cuts, human resource departments. But because of that, you have former bosses that are shifting to non-supervisory positions. You have workers rethinking their career paths because they're saying, well, if I'm not going to get up to this next level, what am I going to do next? And then the managers who did survive, they have like 3 times the workload on their plates. So all this, and then the companies are also struggling with how to motivate the workers who just feel burnt out and who feel like they're stuck.
Yep.
So it was pretty interesting.
Well, I worked on Wall Street my whole career, and there's an ageism issue, which is late 40s, maybe 50. That's it for 90% of the professionals on Wall Street. You age out, and for a variety of reasons, one of which is you've become too expensive, and you can find somebody lower cost to do your job. That's it. I'm telling you, 90% of the professionals on Wall Street, you age out at late 40s, maybe 50. That's the bad news. The good news is you've made a good living through those years, that you have options. You can go to Bloomberg and start a research department, for example. But I mean, and then go into radio. So, but that's a thing. I'm telling you.
Yeah,
it's
and they
a
also
thing.
say too AI could be like a part of that
Oh,
because they could
okay.
be taking over some of those positions as
Yeah,
well. So
fine.
something to think about. And the last one, this was a study in the New York Post that I found. Remote employees feel their social skills have declined when they're working from home. So this is from ResumeBuilder.com. 25% of those who work from home say that their social skills decline. mind. Millennials, they say, are the most susceptible to it. Things like initiating conversations, right? Making eye contact, taking part in group discussions.
Whoa,
things
what
that
about
they
Gen
don't
Z?
kinda do.
Why do
I
they
know,
always
it's
have to beat
always
up on the
millennials.
millennials? What about that other one
So what
behind
do you-
us? Millennial. But like, hey, what about the
So
Gen Z?
Gen Z is what? Like they're younger, right?
They're younger.
Younger,
Yes,
yes.
they're
Younger.
the ones
Yes.
after me.
Okay,
they're
that's
the babies.
those
yeah.
are my kids, I guess.
Yes. But that's what they're saying. Just because they're kind of growing up in it, I guess that's what they know.
Yeah,
they
so my
don't- they
daughter,
never
who
got
I
those
have
skills.
a ton of respect for, she's so much smarter than her knucklehead brothers. She's 4 days a week, but it's a stretch. She feels like it's an imposition, I think, to be 4 days a week. It's and
In
that
office.
yes, and
Okay.
as opposed to just a more flex hybrid thing. But she's reasonable. She's not like, I think she's a totally reasonable representation of her age group, but it doesn't seem natural to them. Why? I'm
Right.
like, well, I don't know.
I mean, I was always going into the office before COVID, so it's different. But I mean, we're still all here, obviously.
my thing was, I mean, for first 25 years of my working career, can I get a day off? Can I please get Sunday
Right.
off? Because we work Saturdays, and
Right.
do I have to come in on Sunday? Really? That was such a drag.
It was.
But we got paid for it, so what the heck?
But you did. But then the ageism thing doesn't
Yep.
help with it. Anyway.
All right, Lisa Mateo with those newspapers, making you think every day.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.